Welcome to a Wiser Retirement podcast. Before we get started with the episode, I want to tell you about a new ebook available on our website called Buyer Beware. Why do they keep trying to sell you that annuity? This ebook covers the various types of annuities, negatives to owning annuities, and better investment alternatives to annuities. To download this ebook, you can click the link in the episode notes or go to wiserinvestor.com and you'll find it at the bottom of the page. Now on to today's episode.
Welcome to the Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom. Today is my co-host, Brad Lyons. Hey, Brad.
Hi, Casey.
All right, so today we're talking about high-yield savings and what we should be doing with our cash. But before we get started there, I wanted to bring up ESG investing, which everyone rolls their eyes because they know I'm going this long rant. But this great article in RIA Intel came out in late April. And basically, the title is How a BlackRock ETF Fell Out of Favor and Sunk Sustainable Fund Flows. So, the whole thing with ESG, and my beef with ESG investing is, forget about the politics behind it. ESG in its agenda is upon us. You're not going to change that. And so the S&P 500 has the highest ESG ranking of any ESG fund. So the whole premise is if you're paying 3 basis points or 0.3% for S&P 500, BlackRock will also sell you a fund that has ESG large cap, which is essentially made up of the exact same companies, charging you 5 times more, 15 basis points or 0.15%. So this very fund, maybe people have been listening to the podcast, Brad.
Well, you have been consistent.
And this one fund, I'm looking for the number, lost. Actually, across the board, $5.2 billion have flowed out of ESG funds in the last 3 months. That's a huge amount. That's like 1/5 of the total amount of money that invested. Most of that came out of the ESGU. So now it flowed into QUAL, which is a quality factor ETF that we actually used here for several years until QUAL looks just like the S&P 500.
Right.
Which is why we stopped using it.
Well, we had duplication.
And it had duplication there. Now I assume that, a lot of advisors don't use the S&P 500 because they think that they can choose these alternate indexes to beat the S&P 500. And statistically, that's really, really hard to do. You have a 6% chance over 10 years. Over 20 years, you have about a 2% chance. So it's better just to have a core of the S&P. Or something like a VTI where it's total U.S.
Right. The total market.
Exactly.
Right. And its market cap. Yeah.
So, but it's just very interesting. I don't know that people just woke up and said, oh, this ESG stuff's ridiculous. I think they left it because it wasn't performing in the end.
They had expectations that were unreal. Unrealistic is a better way of saying it. Regarding those specific companies that had been chosen for ESGU inclusion in it, to outperform. And when you find out that they perform just like everybody else does in the S&P 500,
right? Why
not choose?
Or they're also a lot of ESG highly ranked funds or technology funds, right? Or technology companies or growth oriented companies, which got beat up pretty bad in 22 anyway. So they're probably just looking back and chasing performance in the end. But I don't know. As advisors, our job is not to give people always what they want, because a lot of times what they think they're asking for, they don't actually understand. And I think in the South, we resist this ESG agenda anyway, as a general rule. But I talk to other advisors who are like in the Northeast, Midwest. People come in, they go, yeah, I want an ESG focused portfolio. And I think as an advisor, it's your duty to push back and say, okay, if you want to have an ESG agenda, that's great. If you're in a core index portfolio, your portfolio is already ranked the highest ranking you can get in the ESG world. So why do you need to pay BlackRock $56 million more a year to have a label that says ESG? It just doesn't make any sense.
Right. So it's as you said, talking about clients coming in saying what they wanted. And our role is really to tell them what they need in order to satisfy that, in order to invest
to achieve their goals.
To achieve your goals.
Yeah.
Here's a way to do it. It's a lot cheaper. It's effectively doing the same thing because you're going to get the same returns or better.
It has the same.
It has the same inclusion of companies.
Right. It has the same ESG outcome with a higher rate of return.
Right. Which means that companies are moving in this direction of ESG, environmental. Everybody wants to be good to the environment.
Right.
Okay. Social. Okay. They're looking after their employees. They're trying to be good community members in the community that they operate in. Okay. And governance. How do they manage themselves as a corporation in society? They're all trying to do better. That is what ESG is. So it's happening organically.
It is.
Within companies. Yeah.
And then there's pushback. You look at Disney versus DeSantis.
Yeah.
Disney probably overreached. DeSantis probably overreached. And now they need to kiss and make up and move on. But regardless, that's part of that ESG agenda. Instead of
it is.
Disney saying, oh, we don't care what you're teaching kids in school, we just want to sell tickets to Disney World and buy our movies, they injected themselves into politics at that point. But that is a criteria of the ESG driven company.
Right. If you can leave the politics out, right, where you started the conversation, if you can look at politics aside, companies trying to govern themselves better this year than they did last year and better next year than they did this year, overall is a fine thing.
Yep.
Okay. But when you inject politics in it, you inject an agenda.
Correct.
Right.
Then all your customers are going to agree with.
That's right. And you're going to pay the price for it, so to speak.
Right. Well, Budweiser.
Gosh.
Budweiser did not know their target market clearly, which that's going to be a case study.
It was one can of beer.
I know, right?
One
can of beer and to lose how much market share now?
Oh my goodness.
A lot.
Yeah.
Very, very interesting to watch that. I just remember in business school, all the case studies that we'd be forced, to go through. And I remember Southwest Airlines, that was a case study of Herb Keller and fighting the big airlines and doing point-to-point service, something totally different, right?
Yeah.
And then there's other debacles over the years like Netflix and their, what was it, like $1 or something they raised their fee by, and they lost like a third of their subscribers. I don't remember the exact percentages. Don't quote me on that, but that's another good case study. But yeah, there's a lot of good case studies.
And there's going to be more.
there's going to be more.
For business students coming out in years to come, looking back on this period, there's...
Absolutely.
Yeah, it's going to be fascinating.
So let's kind of transition the conversation a little bit to savings. So there's a couple of things. One is we have these high yield savings accounts popping up, and it seems kind of boring to have a whole podcast just on what should you do with your savings. But yeah, it's the most common question we're getting now in client reviews. So you have the large banks with your traditional savings accounts. They're still paying 0.2,
right,
0.3. They have not changed that one bit. Why? I don't know. Are there a lot of people sleeping?
I think we've been lulled. I think you're right. I think a lot of people have been lulled into, they have accumulated dollars in these accounts, and it takes energy to,
for people to
go back
start
to the
withdrawing
bank,
it,
to set up a new account or to withdraw it or search for another bank or something.
We have our Flight Path program here, which is an automated investment service we do for our hourly clients, and the savings account on that, the high yield account, FDIC insured.
Yes.
It's 4.35% right now.
That's amazing. That's amazing.
4.35% guaranteed account. No fees to Wiser, anybody like that. That's just through the company that we lease their platform. It's betterment.com. We lease their platform to be able to get our own portfolios to an automated investment service called Flight Path. But we get access to the same bank. And so it's 4.35%. I think Amex Savings is close up to 4 now. Discover Bank's close to 4 now.
I looked on bankrate.com, and bankrate.com reviews several, like we're doing now, of banks that are offering high rates and so on. And they just list them. I mean, the highest I saw was 4.85. It ranged from 4 to 4.85 at different banks with different services that go along with the savings account. So I think for somebody who is looking for a higher yield on their straight savings, daily liquidity, they should be able to find 4 to 4.5, 4.85%, in different bank locations. It's up to them to make that move and decide whether or not it's worth it to them.
Yep.
But Casey, this is something we talk about all the time with our clients, and that the role of an asset owner is really that of a steward. To be good stewards of your assets and your money. Cash is no different. Cash should be thought of as part of an asset allocation. And their role of the asset owner is to maximize the return on that asset without undue risk, exposing it to undue risk. In a bank, you have up to $250,000 of guaranteed safety, a return of your money in the event
per person.
Per registration.
Yep.
Yeah. So there's ways to increase that significantly, for a married couple.
So you'd have an account in both your names. That's $500,000.
Right.
Right.
And you each get $250 for that. Okay. You have an individual account, so there's another $250. You can have an IRA account, that's another $250. You have a Roth account, that's another $250.
Yep.
You can have a trust account, that's another $250
per trustee, right?
Yes.
Yeah.
Okay. Yeah. So look, I mean, it's potential to have quite a lot of money, guaranteed by the FDIC. So to maximize the rate of return that you're getting on your
that should put to bed any issues with regional banks that people might have.
Right.
As long as you stay within those limits.
Right. Exactly. And the government has effectively guaranteed everything beyond that for this time period, whether we're going through this whole banking concerns that we're having, the issues of the 3 or 4 banks that have failed or nearly failed. So right now it's time for, as consumers, to seek out the best return that you possibly can. And we do that through stock investing, bond investing, cash investing, real estate investing, etc.
Yeah.
And it all plays a role in our overall portfolios and our financial well-being.
So if you think about, 4.35% guaranteed rate of return, another question I keep getting is, well, why wouldn't I just put all my money there and not have anything in my stocks? And the short answer to that is, in the short term, that may give you more comfort, but in the long term, that's not a good investment strategy.
No, it's not. And anybody, there's been enough news around this for generations now.
Right.
That in putting money in the bank is in the end you lose money in value, in purchasing power, due to inflation and taxes. Because this is taxed as ordinary income in taxable accounts. So the two combined generally create what would be considered a losing proposition. So when we look at cash allocations, we're looking at short term, near term, and medium term, and that's about it. Okay, and it's cash that's available for emergencies, and that's a little bit longer out the spectrum. It's really an allocation to provide stability and liquidity in your portfolio. Okay, so we know that there's really 2 types of people out there with cash assets. There are savers and there are investors. Okay, and for savers, they should approach this in one manner. For investors, they should approach it in a completely different manner. Okay, both accomplishing the same thing: having money available for emergencies and opportunities while gaining the highest rate of return possible for that during that time period. Because cash is also thought of in terms of time and periods. Stocks and bonds are thought of much longer term, 5, 10, 15, 20. Our planning goes out 30 years, out to age 95 for people. So cash is not appropriate in that sort of rate. But when we're looking at 0 to 3 or 6 months as an emergency reserve, cash is the perfect vehicle for that, has daily liquidity. And in money markets right now, you can gain 4.5 sometimes in interest rate. It was just a year ago, 14 months ago, we were gaining 0.5% in money market.
So do you think about things in buckets? Emergency reserve is obviously a cash bucket, which was earning nothing, but now can earn 4+%. Your next is going to be bonds inside your portfolio. So for young people, maybe it's 10%. For older people, it might be 40%. If cash is giving you 4%. What are our bonds giving us now?
Well, it depends upon the duration of the bond. We use a couple different bond ETFs in our portfolios to match the duration or time frame for the money, depending upon the circumstance. So we use something called an ultra short bond fund for the near-term cash needs. Okay.
So inside the portfolio, you still have near-term cash needs.
Correct.
Right?
Yes.
And then you have longer-term cash needs. So
that's right.
Short-term fund is yielding what now?
The short-term fund, the ultra-short bond fund is earning 4.95% right now.
So, okay. And if we go out to the 30-year?
It's actually earning a little less, but it is filled with bonds that were issued years ago.
Yeah.
Okay. Now, the unique thing that's happened in the bond markets today, both near-term, medium-term or intermediate, and long-term, is that they've been discounted in their price levels right now. And so their valuations have come down, which means as they mature to par, okay, you'll get price appreciation. So in bonds now, you look at the combination of the two, not just singularly in terms of the rate of interest that their coupon's playing. So in the short-term bond, which is generally, you look at from 1 to 3 years of maturities, you're gaining a little over 4%, 4.25%, I think I saw on BSV, which is what we use. But you're also going to get price appreciation because as these bonds mature in the next 1 to 3 years, they are going to mature at par, whereas they're trading now at something significantly different than that. Okay, and when I say significantly, 10, 15%,
right.
loss in the bond market last year.
Yeah, so when you think about terms and bonds in our portfolios, this is shifting the topic a little bit away from short-term savings. But when you think about bonds and portfolios, do you feel like that the storm has passed now and bonds will perform more historically normally inside the portfolios? Yes.
And that's, you talk to bond managers right now, they're the most giddy people in Wall Street to talk to. Right. They are very excited about managing bond funds again. And it appears that as we're going through this interest rate hiking cycle with the Federal Reserve, we're going to talk a little bit about this in a few minutes, that each time that they increase, the rate of increase is smaller than it was when they began hiking interest rates, where that rate of increase was very large, sometimes doubling each time that they did. So now, like in May, earlier this month, when they raised rates, they raised it 0.25%. So it went from 4.75 to 5. So that rate, increase is much smaller. So the effect of changing interest rates on bonds going forward should have a much smaller rate. And in addition, the bond market, just like the stock market, is a futures discount, marketplace. So they've already discounted future rate hikes in the current price of this. So I think that what we're going to see is a stabilization in bond prices, plus appreciation, as I spoke about earlier, plus the new interest rate coupon that's being paid on these.
Yep.
Yield is the word I'm searching for. Bonds are now a significant part of an overall strategic portfolio with rate of return, that we haven't seen in years.
Right.
Yeah. And should rates decline going forward, it's a future event, so we don't know, that price appreciation will happen much more quickly.
So going back to our cash reserve situation, these high yield accounts typically don't have minimums. You can withdraw as much as you need to out of the accounts.
They have daily liquidity.
You
Absolutely.
can connect it to your checking account. Money can be there within a day, usually, of when you do the withdrawal during business days, anyway.
Yeah.
And they're FDIC insured. So, really, for our listeners, if you haven't jumped on this bandwagon, this is probably time to do that, because your big bank savings accounts aren't doing any favors at this point.
No, they're really not. Banks are not necessarily your friend at this point in time, although cash is your friend. So maximizing the return on cash is certainly something that's worth your while, given that you're going from 0.2% return to a potential 4 to 5% return. And for savers out there, and let's talk to them for just a moment, the way to set up a cash portfolio, if you will, is to utilize money market funds, CDs of varying maturities, so that you're constantly having, money coming due to take over in the event that there is an emergency. So you're no more than 30 days out from a portion of your cash. So for people who have cash reserves in excess of what they need immediately, they should divvy that up 3 or 4 or 5, times, and then ladder out a maturity of CDs. 1 month, 2 month, 3 month, 4 month, 5 months, 6 months, etc. equally. So every month, a portion of your money is coming due, and then it's being recycled back into the portfolio 6 months out. So you literally are creating every 30 days, money is coming due. If you need it because of an emergency, you have some money set aside still, plus the next portion of the 30 days out coming due as well to take care of those needs. So, and you're maximizing the return on that money, plus it's guaranteed. So that's a way for savers to, maximize the return on their portfolios in cash. For investors, as we've talked about, it's utilizing, a money market fund in a brokerage account to a 0 to 3 months if necessary, or a percent, could be a percent or two of your overall portfolio. Then it's looking out the next 3 to 12 months and putting it into an ultra short bond fund. And then from the rest of the money, you're looking out beyond that, if there's still is utilizing it in the portfolio as a short-term bond fund, where you gain price appreciation plus the coupon rate. So
these are all strategies to maximize your savings. We're not talking about portfolios necessarily in this case. This is just how to handle your savings accounts.
That's right. Exactly. It's excess reserves that you may have. Okay.
So we are, I guess, about a little over a quarter of the way through 2023. 2023 is supposed to be the worst year ever for investing. There were dire predictions. People were scared, or maybe they still are. I don't know. But we're actually up, about 4% on the S&P?
A little more than that. Even though this week has been a little bit of a rough week, a little rough patch. I think I saw recently the S&P was up about 7% still. So, we're looking at, returns cycles that after an event such as 2022, when interest rates were raised in an aggressive manner. I want to talk a little bit about that. What happens thereafter?
Yeah.
History tells us that after a rate cycle hiking is through, 12 months out, the markets are much higher than they were prior to that they were at that point in time. So it is a cycle that occurs within our economy, whereas the economy heats up, the Federal Reserve's job is to make sure that it doesn't overheat, okay, and cause inflation, which was happened last year. So they use interest rates to raise the rates, cool down the economy, slow it down a bit, reduce inflation. Okay, that can cause a recession. Often does. It's unfortunate. It's part of the cycle of renewal, in an economy. But then the stocks, companies, performance begins to rise thereafter. And it's just a cycle that we go through. And I've got a couple cycles here that I want to share with us. This cycle started in March of 2022, and it's been one of the most aggressive, if not the most aggressive, rate hiking cycle. It's lasted 14 months. We've raised interest rates 5%, from 0 to 5%. That was 10 rate hikes. They used 75-point rate hikes, increases 1, 2, 3, 4 times, okay, in a month. Huge. It's never happened before. The last time we raised rates was from 2015 to 2018. So this was over a 3-year period that they raised rates, and they only raised them 2%.
Right.
Okay. It was 36 months. So it was 9 rate hikes no more than 25 basis points at a time. During the housing boom, during 2005 and 2006, they raised rates for 24 months, a total of 4% on 18 rate hikes, just a quarter point each time. Okay. The last one that was as aggressive as this one, and this is the one that I think is most closely resembles our current environment. In 1994 to 1995, Alan Greenspan was the head of the Federal Reserve. Okay, and he raised rates in an aggressive manner over 12 months. He doubled them, but it only went from 3 to 6. or thereabouts. Okay, 7 hikes, but that was still over a 2-year period, and that was the last time we saw a 75 basis rate hike. It's been almost 20 years since we've seen a rate hike that we saw 4 times last year, and it was the one time that the Fed was able to create what they call a soft landing in the economy, where even though they raised rates, they raised it in an economic cycle of low unemployment, which is what we're in now, of technology was just beginning to take its footing, getting footing into the economy, and the basic reasoning and purpose of it was to increase productivity. Computers were on every desk back then, for in most companies. So it increased productivity. So if you can increase productivity and increase interest rates, you can cause a smaller chance than of going into a recession. And what are we in now? We're in kind of an inflection point. We have very low unemployment still. What was it, 3.5, 3.6%?
Right.
The economy is still strong. They're raising interest rates very aggressively. And we're in a unique period with technology again, aren't we? And we've talked about this, at length in some of our broadcasts. You have,
AI.
Mm-hmm. You have different, currencies coming online. You have blockchain technology. You have a lot of new technologies that are going to robotics that are working their way into the economy and through the economy. And it may be that this period is most closely resembles the 94 to 95 rate hiking cycle. Okay.
Yep.
And we may see something like that. We know what happened after that. After 95, 96, 97, 98, 99, the stock market went way up.
Yep.
So
that goes back to 2023 is not panning out the way I'd say 99% of analysts said that it would. So do you think that we're potentially out of the woods this year?
No, we have something significant coming up next month, and the administration and Congress is trying to work through that. That is the debt ceiling. But if we can get past that, either with a resolution or a continuing resolution for a short-term period, I think the markets will respond favorably to it. Okay, we may see a couple more rate hikes.
Yeah,
but what we're seeing is, as employment numbers came in last month, 236,000 new jobs, but in actuality, 900,000 people went to work last month.
Right.
Okay.
It's not a negative number.
That's right. And we've seen these, job increases, continuing. Employment's down to 3.6, 3.5%. More people working, more people earning, more people paying taxes, more people buying goods and services than before. We kind of really have to grow our way out of this rather than destroy our way out of this. If we can maintain this pace, okay, we may be able to grow our way out of it. Wages are increasing. We saw at a rate of about 5% a year. Okay, inflation's at about 5% a year right now. I think last reading was 2 months ago, it was 5%. Now it's 4.9. So let's say it hovers around 5%. If wages are going up 5% and inflation is going up 5%, that seems to be kind of a net.
Right.
Okay. If we can utilize new technologies, new methods in the economy of producing goods and services and increase productivity, we can begin seeing real raises in the standard of living, okay, in the U.S. So the reality is we might be in a near soon to come into a golden period of the economy and the stock market responding to that, in the next year or so.
Well, I hope you're right. A lot of people are, I think, negative. Interesting you didn't say elections would drive the stock market at the end of the year. And I don't know why you didn't, because it doesn't have a whole lot of bearing.
That's right. We talk about this in several other podcasts.
Yeah.
Just exclude that, okay?
Yeah.
This is the system what we're working in. It's structural. Every 4 years, we're going to change over our administration,
So, the theme this quarter, or the theme for our podcast, I think now for probably a long time, is financial success is intentional. Episode 143, we talk about that. And you can't be asleep at the wheel. Make sure you're taking advantage of high yield savings accounts. Don't live in fear of the stock market this stuff always has a way of panning itself out, especially when you stick to the core indexes, like the S&P 500. We talk about a little bit about successful investing, episode 102, low cost, diversified long-term investing. Also, don't forget to check out our YouTube channel. It's called A Wiser Retirement, just like the podcast, where we have bonus videos from myself and Missy talking about things happening, what people are searching for in the financial world. Anyway, thanks for listening to today's episode. If you want to learn more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click on the link episode notes. See you guys next week.
Great.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced and edited by Ken Hoadley. This podcast is strictly for informational purposes only and is not to be considered as investment advice or a solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investment advisor with the SEC. The host and or guest may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guest of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.